Hello, everyone. Welcome to today's webinar with Aaron Stachel.
Stachel?
Stachel, Aaron Stachel. And I just wanted to welcome everybody, letting you know that if you guys would like to talk, there's a chat feature, and that if you guys have the drop-offs later or you guys want to rewatch any of this, it will be up on the Project Excite website later on this week. And I'll just pass it off to Aaron to take over.
Great, thank you. Happy to be here. And normally I would do this as a kind of informal whiteboard session. So since I don't have a whiteboard, I made a few slides that we can go through, but use the chat tool if you kind of want to ask a question about something that I'm talking about. And then we can kind of keep it conversational that way. And so and you can still see my slides, right? And so Aaron Stachel, I'm based here in Denver. I did go to DU for my MBA that I finished in 2011. And I've been doing this for about 7 years now. I joined an entrepreneur who had started the fund named Bill Miller. He started a company in the late 90s called Storage Networks in Boston that was really one of the first cloud storage companies. And I don't even think they called it cloud storage then, but he took it public, had done a lot of investing personally over the years, and was looking to build his kind of angel investing into a firm. And I was looking to find a kind of smaller, faster growing, more interesting company. I was doing kind of M&A and investor relations at a big company after my MBA and wanted to kind of get down to the startup land. And so a mutual friend connected us at the right place, right time kind of situation. And so I've been helping build this into a firm. So the firm is FirstMile Ventures. We do seed stage investing. So I'll talk a little bit more about kind of what seed stage is and how it's changing. We're not a thematic investor, so we don't invest in kind of specific things. We really build our investment thesis around the founding team and their kind of unique view of the world and expertise. We just finished investing our first fund. We did 31 companies in that. All seed stage. About 2/3 of them were here in Colorado. 1/3 were spread out. We do a lot of B2B software as our comfort zone, but we do kind of branch out from that. We have robotics companies, some consumer-facing companies and marketplace companies, some digital health companies, and so we have a pretty good mix in the portfolio. And today, the idea for this session was kind of a VC 101. And so I'm going to talk about kind of what is VC and who it's a good fit for, kind of how that early stage investing landscape has been changing and how that impacts, raising around, and kind of given the current environment we find us in with COVID, I'm going to just talk a little bit about how that's impacting the venture landscape, and plan on leaving plenty of time for Q&A. But again, if you have questions about what I'm going over in the meantime, just jump into the chat and we can address them as we go. And so to start on, what is venture capital? And it's a private fund. And so this is the Wikipedia chart of how a venture fund is structured. And generally, we're out raising money, so venture capitalists have to raise money also from what they call limited partners. And those, for large kind of established funds, those tend to be institutions like pension funds, university endowments. And then for smaller funds, they tend to skew more towards high net worth individuals or family offices. And so we pool capital together from those investors to create the fund, and then we invest it into startup companies. So you can think of it a little bit like a mutual fund, but instead of public equities, we're investing in small private companies and startups. And so when those startups have, exit events, they return that capital to the fund, and then we turn around and deliver it back to our investors. And they're looking for usually a 3x return on their money is considered a good venture fund, which kind of puts it in the 20% plus annual rate of return range. And I think the reason, kind of understanding how a fund is structured, is there's a cycle here. So venture capitalists are typically have to go out and raise a fund, then they're making investments for 3 to 4 years out of that fund. And then they might follow on in companies beyond that, but then they're typically raising another fund to do new investments, and then they won't overlap investments in those funds. So, they tend to be 10-year cycles, plus usually a couple years of extensions as things tend to stretch out longer. But, those investors have to deploy that capital, get it back with a return to their investors in that set amount of time. And that tends to drive kind of certain behaviors and structures that we'll talk about a little bit more down the road. But there's a traditional venture capital firm like us, other kind of early stage investors that are kind of investing alongside us or around us, are accelerators. Like we have Techstars here based in Colorado, and a number of others. Angel investors sometimes participate in rounds alongside us, especially in early rounds. And then corporate venture capital, which looks a lot like the chart that I have up here, except the limited partners tend to be one large company. So a lot of big companies have a venture arm, and that's how they kind of outsource some of their innovation and make sure that they're part of kind of the next big thing. I think something else important to understand about venture capital, it's geographically kind of concentrated in a few areas. And I think this chart from CB Insights really does a good job of kind of showing that concentration. So, a huge percentage of it goes to 3 states: California, New York, and Massachusetts. And so, when you read about venture capital and kind of what's happening, it's important to understand that they're probably not talking about Colorado and how things work here. They're talking about how things work nationally. And when I say nationally, that's usually in one of those 3 states is where the vast majority of venture dollars, the funds exist, and then the investments that they deploy those in. And then you kind of have a second tier of states that would include Colorado. And, Colorado is certainly has a robust venture ecosystem. It's, I would say, growing. But it's important to know that even though it's a, top 10 state for deal flow, I think it was 7th in this most recent quarter by activity. I've seen it as high as 5. And Denver is now a kind of top 10 metro area for deal activity. Again, I've seen it as high as 5 a quarter or 2 ago. But it's still, relatively small in the grand scheme of things. There's a pretty big drop off from sort of the top tier to the second tier. And then, getting beyond kind of what is a VC fund, I want to talk a little bit about who should raise venture capital, because I think the important thing to understand here is it's a very rare type of company that should raise venture capital. It's not just any new company. It's a new company that kind of takes a certain shape. And so, I describe these as rare businesses that can achieve scale quickly. And so, just a little bit of kind of more inside baseball on how a VC fund invests and builds their portfolio kind of dictates what kind of companies they're looking for. And so the chart on the left of this slide kind of shows, for every, they start with this batch of over 1,000 seed stage companies and look at kind of how many of them can make it to the next level. And if you look at that, the first line, 38% fail to raise a second round and 14% kind of have an early exit. And so that's, over half the companies don't make it to the next round or to any kind of big outcome. And so I think that's really important to understand, the risk, when you're investing, especially early at the seed stage, how risky these companies are. And you can see on the bottom, at the end of the funnel, about 2/3 of the companies just don't make it to a good outcome. And, only 1% kind of reach the unicorn status of $1 billion valuation. And so, it's important to recognize that venture type of outcomes that people talk about a lot are really rare. And because these companies are really risky, the return expectation is really high. So, I mentioned how a VC fund is typically looking to get 3x return back to our investors that invested in our fund. But to get that 3x, it doesn't sound like a huge multiple, but when you look at this chart and the failure rate of these companies, if you look at a typical VC fund that has 30 companies, we're going to assume half of them go to zero, and then there's another, or almost half. So I'm showing 12 here. 12 are small exits. So, or maybe you get a little bit of your money back, but you still lose money, to maybe like a 5x return. And a 5x return sounds pretty good, but it's probably not going to make up a big impact on the fund economics. It's really these kind of, I'm modeling 6 kind of good or great outcomes where 80% of the venture fund's performance is going to be determined by this handful of companies that have kind of a good to great outcome. And a great outcome is over 10 times invested capital. And we're a lot of investors hope to get one investment that returns the entire fund or better. And so out of 30 investments, it's probably gonna have to be at least a 30 times return on invested capital. And so to get one of those in a fund, you need to do 30 that look like they could produce that type of outcome, knowing that a lot of them just aren't going to make it. And so to get to 30 times invested capital in 7 years, you have to be a type of company that's probably going to get to 50+ million in revenue, growing at least 100% a year, and a lot of upside from there. If there's a big M&A event or an IPO, the reason the valuation is going to be high is because there's a belief that these companies can keep growing beyond that pace. And so you might look at that and say, well, geez, hardly anybody could do that. That's a really unrealistic expectation. And I would say you're correct. And I think the important thing to understand there is that if you're going to raise venture capital, you kind of need to understand that's the expectation of your investors, and you should have alignment around that. And to get into kind of how an investor decides or estimates or judges, what kind of company could achieve this type of outcome, you'll often hear people talk about, 3 main areas. So the people, the product, in the market. And so, on the people side, they're really looking at, why this team, what makes them uniquely positioned to go capitalize on this opportunity, and how did they kind of identify this problem, and how well do they know the customers, and are they really connected to the people and businesses that can, make them, successful? Do they have the ability to kind of recruit and retain, best in class talent to build this type of organization? On the product side, it really has to be something that is solving a really important problem for their customers, a big pain point where, it's not, you'll hear the term sometimes, is it a vitamin or a painkiller, where a vitamin is sort of, optional and people may or may not spend money on it, even if they should. And then there's kind of the pain point where, somebody has this problem, they're looking for solutions, and they're willing to spend money, time, and resources to implement that solution. And so there's a pull into the market for what you're doing. And, and beyond that, is it a unique approach to solving this problem that, other people haven't thought thought about yet, and has some advantage. You'll hear, is it 10 times better or 10 times cheaper than existing solutions, or maybe the old solutions were built on a certain architecture over the years, and they can't pivot. Now the time is right to do it in a new, innovative way, and then kind of the juggernauts of the industry just can't turn the battleship, so to speak, as fast as a nimble startup can capitalize on that opportunity. So there's got to be a way on why you can get out into the market in a way that your competitors can't. And then lastly, that market has to be big, to support the types of revenues that you have to get to achieve the big 30 times outcome that I mentioned. You have to be in a really big market, because chances are you're not going to take the whole market. And so typically, it's a minimum of $1 billion plus type of market. And that's not to say it has to be a big market today, but there has to be a belief that this market, maybe it's a nascent market, but you believe that 5 years from now, it's going to be a really big market, because this new technology or solution didn't exist until now. And you think of things like ride sharing, and a lot of people made the mistake of looking at Uber and saying, well, the taxi market is only so big, and if they only capture so much of the taxi market, the business will be this big. But they created a big space in the middle where a lot of people use rideshare that never would have called a taxi or a black car service. And so having a story around that, I think, is really important if the market isn't big today. And I have this kind of catch-all here where the importance of storytelling, and the founder and management team's job when they're going out and raising capital is to kind of weave all of these elements into a compelling story that that pulls all of this together in a way that it's, wow, this is a huge opportunity, and there's a really unique solution that they're bringing to the market, and this team is just so well positioned to execute. And when you walk out of a meeting, you should really understand kind of all those things in a way that kind of holds together in a nice, neat story that again, I can turn around and go to my partner and say, hey, I met this company, here's what they're doing, this is why it's a big deal, and why it's such a great team, and I think we should spend more time on it. Or I could show it to another investor and quickly explain that. If it takes 20 slides and a half hour to get that point across, then it's probably going to get lost in the weeds in a lot of cases. And so full disclosure, I am a VC, and that's what I kind of know and understand the best. But I do want to touch on, is maybe many of the people that are listening in today say, well, maybe that's not the type of business that I'm going to build. I'm not going to get to 50 million in revenue and hire hundreds of people, or I don't want to do that. That's not interesting or exciting to me. I want to kind of work with a small team and get kind of to a sustainable, profitable place, and run, a business and kind of keep control of it. And, that is a noble thing to do. And that's the way the vast majority of businesses go about it. And I think it's also important to understand that just because you might not fit into a venture capital sort of portfolio model doesn't mean you don't have a good business idea and opportunity that is very well worth going after. It just means you might have to find a different way to fund it. And so, when companies are starting up, they almost always raise some money from angel investors. Sometimes that friends and family, angel investors, people that kind of really are making a bet on you. And, venture-backed companies often start that way. And so do, pizza shops. That tends to be the way people get money to get off the ground, is maybe they've made money in the past and they do it themselves, or they've got people around them that that believe in them, that help them get the company off the ground. And again, the way that most businesses go from there is, they sell products to customers that generates revenue, and their cost of delivering that revenue is low enough that they generate a profit that allows them to invest in growing their businesses. And you sometimes hear that referred to as bootstrapping. And so it's really getting funding from your customers, and that's often the cheapest, best source of capital that you can get. Even if you are a venture-backed company, the faster you can grow your revenues, the less capital you have to raise, the better your valuations are going to be, the more ownership you'll retain of your company. So even if you do raise capital, you certainly want to look at a model that generates a good revenue, and especially if that revenue comes up front, or I should say the cash comes up front, where maybe you're selling annual contracts and your customers pay on day one. You get all that cash up front, which allows you to kind of deliver over the year, and as long as you keep selling, that gives you a lot of flexibility to grow your business without raising capital. Crowdfunding, especially for physical products, you'll see people launching products on Kickstarter. Grants, here in Colorado, we have the advanced industry grants, which are designed to help support companies that are building things in advanced manufacturing and technology, industries that the state has a vested interest in supporting here. So sometimes you can get some grant money. There's other types of grants kind of through the federal government. And sometimes those require matching with investors. But again, it's a low cost of capital way to finance the business. Working capital finance is another one where you can get an invoice, and you can take that to like a factoring company, and they'll give you kind of 80% of the money today, so you don't have to wait to get paid. Especially if you're selling to big companies, you might kind of have the expense of kind of shipping a product, but they're not going to pay you for it for 2 months. And so working capital finance helps you kind of cross that gap. And if you're not going to raise venture capital to get started, that doesn't mean that you'll never be able to raise capital. VCs tend to invest in companies that are really high risk, high reward. And, there's a lot of investors that are, lower down on that risk reward curve. So they don't need as big of a return to make their model work, but they're not going to take a lot of risk. But once you get your company to maybe $3-5 million in revenue, you start to unlock different sources of capital. Like banks will give you a line of credit. There's growth equity investors that, will invest similar to the way a venture capitalist would in terms of buying equity in your company, but they're happy to make 3 to 5 times their money in 3 to 5 years, where that's kind of below the threshold of what a VC would, underwrite to. But these funds, to make that work, they tend to invest later. And there's also royalty-based financing. So, if it doesn't look like there's going to be a big exit opportunity, it's a way that investors can get their money out with the return. The benefit of that, it's not cheap capital either, but the benefit is, you retain control and it's not debt. So, if your revenues drop, so does your payment typically. And so it can be more manageable that way. So I want to touch on those. I'm happy to answer questions there, with the caveat, I'm not an expert in any of these sources of capital. And so kind of getting back to venture, I want to talk a little bit about, I mentioned that we're a seed stage investor. You kind of might be hearing different things about what a seed round is. That can vary a lot by geography, and the fund that you're talking to. And so I'll caveat everything I'm going to show here with, think of these as ranges, and these are kind of very fuzzy lines, not hard lines. So for everything I say here, you won't have to look too far to find an example where, an exception, I should say, to the rule. But these are good rules of thumb, I think, to give you a sense of kind of what the different rounds are. And I'm going to focus really on those early rounds, because I think many of you listening, that's kind of where you would be getting started. And so I'm going to take a sip of water here. And again, if there's any questions, please jump into the chat, and I'm happy to take a break and address those as we go. So, in the old days, before I was doing this, I'll call it sort of pre-2006, before Amazon Web Services and things like that, typically you would start with the friends and family, angel round of less than $500,000 to kind of build out the initial team and maybe a prototype. And then you would go raise a Series A from a venture capital fund of, $2 to $5 million. And back then you would typically have to, buy all of your service to host, all your servers to host your web service. You need to hire all the developers to build, your payments backend, because you had to build everything from scratch. So it took a lot of money to get these companies started. And so the Series A was often a pre-revenue round. The product was very early and probably not fully built out yet. And so you would spend the Series A kind of getting the product off the ground and maybe launched, and then you would raise a Series B to go scale that. And so as, things like Amazon Web Services that kind of are outsourced, IT infrastructure, things like Stripe for, payments, or Twilio for messaging, or, the API economy in general, where you don't have to build all the code yourself. You can just tie into APIs. You don't need to buy your own servers. You can very cheaply get started renting servers from Amazon. And so, those Series A investors said, these companies can actually make a lot of progress before we invest. So why don't we just wait a little bit, see who gets some traction, and then we'll invest in the ones that look like they're starting to take off. And so that kind of created a gap between the angel round and the Series A, and that was filled by seed funds. And so, I think the first ones were sort of formed around 2008. And now it's really kind of become a distinct phase of financing. And it's been sort of institutionalized. There's seed funds that are as large as, $100 million now. And they can be as small as, $5 or $10 million, like our fund, our first fund at least. And so the seed round is now, oftentimes pre-revenue, but has an early product, and then you're getting that product out into the market to demonstrate some traction and raise a Series A. This is kind of where Colorado is today in some ways, as there's, as I mentioned before, there's just not as much capital here, where there's hundreds and hundreds of seed funds out in the California market. There's maybe a half a dozen or so here in Colorado that are active, and those funds just aren't enough to kind of fill out are really robust. So it's almost usually augmented with out-of-state capital to some degree, and kind of where those large markets have moved to, and you might see here in Colorado from time to time is the bar for A keeps kind of moving up, and so kind of to fill this gap that gets bigger and bigger between the angels are always kind of at the same place. They're the first money in, and then there's this sort of gap that kind of keeps getting bigger as the bar for Series A goes up and up. And so, a lot of times now you're seeing a seed round, 2 million or more. The companies have a product, have some revenue, and then kind of, to get there, they might have raised, a pre-seed round that is maybe, in between, the angel round, the seed round. Maybe it kind of, overlaps a little bit with the seed round. Again, these definitions can be kind of fluid, but you'll hear the term pre-seed, you'll hear the term late seed, where a Series A used to be kind of $5 million, and you still see rounds like that, but It's also not uncommon to see a $10 million Series A round now, and those companies have meaningful traction. And so the bar to get there has gone up significantly. And so companies are having to raise more and more capital at the seed stage to get there. And so I think it's important to understand kind of what this spectrum looks like. And again, what it looks like in Colorado, there's just not enough seed funds to flush this out, where in California, you'll see funds, specifically focused just on pre-seed, where here, there's funds like ours that will invest kind of across this spectrum. And then, you can kind of keep going down the path here, but we'll keep focusing on these early rounds. And so, to kind of pull this together, I want to talk a little bit about, what does this mean for you if you're thinking about raising your first round of capital, and how would you go about it? And so, again, jump into the chat if you have any questions about, anything I've covered so far. So, the first thing you need to figure out when you're going out to raise money is kind of, how much money do you need? And you've got this kind of big vision of where you want to get the company to, and you kind of have to back plan to where you're at today. And so, I kind of showed these rounds of funding. And again, it's important to note, I'll pull this back up again, but, each investor is investing in a plan that they think will get you to the next step. Sometimes that next step can be profitability, and maybe that's just interim profitability, where you get profitable on the business that you have, but maybe you still raise more money to keep kind of accelerating your growth rate. But generally, companies that raise venture capital get into a cycle where they have a cash burn. So they're investing so much in growth, it's beyond kind of the profits that the business produces. So, they have to go raise more capital. And again, this is why some companies may choose not to go down this path, because they want to just get profitable and grow more organically, and which might mean more slowly. But that's just a different way to grow a business, and often it doesn't produce the outcome in the time that a VC needs to return money to their investors. So it might again be the right way to go about it for your business, but it just might not fit in a VC fund. So each investor is looking at this and saying, do they have a reasonable plan to get to the next round, the next stage? And so as you're thinking about, how much money should I raise, it should be built around a plan of what do you need it for, and does that get you to the next place? And so once you figure out kind of how much money you need, and based on where your business is at, that kind of, drives you into, the type of investor that you are going to need to work with. And so you need alignment across all those factors. Do they write checks in this size? Do they invest in companies at my stage, in the industries that I'm in? And are we both kind of aligned on the type of outcome that we're shooting for? And again, another caveat on kind of who should and shouldn't raise venture capital is, it's usually once you start going down that path, it's really hard to get off, because the investors that backed you with this idea that we're shooting for a really big outcome, there's a lot of pressure to kind of keep going for that, even if, the business gets to a place where, maybe that's not what I want to do anymore, because this is, harder, it's very taxing. It's very hard to grow a company that's hiring more people every year than existed the year before. It's a very intense way to grow a business, and it's certainly not for everybody. But the investors that are going into this thinking that that's what we're all going for, might have protective provisions that keep you from selling the business too early and things like that. And so, it's important to really kind of understand what you want out of it, what your investor wants out of it, so that you don't end up in a place where nobody's happy. And so once you kind of figure out, what investors would be a good fit for you, and besides just what kind of outcome you're going for, it's, these can be really long cycles. The average, I think, time to exit is 7 years. So, this could be somebody that you have a very close working relationship with for a long time. So beyond, do we want the same thing? Is this the type of person that I want to work with, that, I want to go down this journey with? And so that's, it's important to have fit around those things too, because you could very well end up spending, a lot of time together over many years. It's also important to understand that, this is a process that can take a long time. The CEO of the company is typically most responsible for fundraising. And it's almost a full-time job during that process. And other members of the team are likely to get pulled into the process. But the CEO is typically responsible for, most of the outreach and presenting and following up. So once you have that list of investors you think are a good fit for you, you need to get in front of them. And so building a plan with your mentors and advisors and maybe other founders that you find connections to those investors. And it's usually best to find a warm introduction, given that a lot of investors get way more inbound than they can handle or spend a lot of time looking at. So we're a pretty small fund, we're a newer fund, but we still only invest in kind of maybe 2 or 3% max of the opportunities that we see. And so to get kind of the top of the stack, I look at everything that comes in through our website, but sometimes my inbox gets backed up, like I'm sure everybody else's. So if I get, a note from another investor that says, hey, we just backed this company, or we just gave them a term sheet, or, the CEO is a rock star, they have this great expertise, they've got this huge opportunity, I really think it'd be a good fit for you guys. Do you want me to make an introduction? It's almost an obvious yes, I would like to talk to them, because assuming it's an investor I know and trust and have worked with before, it's and they're excited about it, I have good reason to believe that I might be excited about it too. And again, more often than not, the answer is still going to be no, we're not going to invest. But that's probably one that goes to the top of the pile in terms of the next meeting I'm going to take, where I might, in a day, get a handful of things that come in cold through the website. And I will look at them and I will get back to those emails eventually, but sometimes they just don't move up the priority stack. So you certainly can reach out cold. And if you are, you should have a very kind of clear, concise reason that specific investor should be interested and want to engage with you. And so, if you've kind of done your homework on investor selection, on who would be interested in your company and why, and you kind of reach out to them, kind of clearly articulating that in a very concise way that they can look at it and say, oh, this kind of fits squarely into the types of things we're interested in, and they have a compelling story here, I should take a meeting or look at the deck, or take that next step. And something else, as you're building that outreach plan, you kind of want to balance, maybe reaching out to the ones that the best or have the best intro or connection to begin with. But you also want to prioritize investors that could lead you around, because that tends to be a catalyst that helps the whole thing go faster. So if you have an investor that can write a larger check, and a credible lead is usually going to write a check that can take a third to maybe a half of the round, So if you're raising, $1 million seed round and you've got an investor that is going to do 500,000, negotiate the term sheet, they'll often help you get in front of other investors. We all have lists of other investors that we work with, that we kind of share deals with. And so if you can get that lead investor to bite, that typically will make the rest of the process go a lot smoother. And you might get small investors that are interested, and maybe they commit. So it's like, hey, you're raising $1 million. I'd like to invest 50,000. It's certainly great to have that interest and commitment building up, but it's typically, they're not going to lead the round, negotiate a term sheet, and do all that other work to get the round done. And so it usually works better to start with the larger investors who can lead your round, and then fill out the rest of it with small investors, or maybe one or two other large investors if you can. And then, as you're going through that process, it's important to understand that it is a process. It could take a long time. It can take 6 months to pull a round together. Again, most people say no to most investment opportunities they see, and you just need to be prepared to get a lot of no's. So you need a large funnel of potential investors to talk to, because you're going to only make it kind of out the bottom of the funnel with a few of those. And so just plan for that. You don't need to get everything done, get to a yes in the first meeting. You're gonna, your goal is always just to get to the next step. So maybe the first step is to get an intro call, and then if the intro call goes well, you'll schedule an in-person meeting. If that goes well, maybe you'll get introduced to another partner at the firm. And you always want to just keep taking the next step, and don't expect to get a yes right away. It can take a while for a firm to get up to speed on your opportunity. We've committed to deals very quickly in some cases, in under a week. In other cases, it wasn't a right fit, and the company went back to work, and it took a year by the time we actually first met the company, and then we maybe invested in the next round, or the founders decided to bootstrap a little bit more on their own. And so it's important to understand where you're at with those investors and kind of what they want to see. And it's always okay to ask. You have to kind of be wary of investors that are just kicking tires and asking for a lot of information. It's certainly okay to ask and say, okay, if we kind of show you this, is that what you need to be able to invest? And so it's okay to kind of really push to understand where you stand, so that you don't spend a lot of time talking to investors that ultimately aren't going to invest, and maybe they're just gathering more information. But you hate to see a company go down a path with an investor where they spend weeks or months kind of exchanging information, and the investor passes on something that they knew kind of very early on in the process. You want to avoid that situation where you're wasting a lot of time. And each one of those meetings you have, you're gonna learn something. And it's important to understand kind of what the objections are about what you're doing and what you're working on. It might cause you to think a little bit harder about whether this is the right opportunity to pursue, and it might strengthen your resolve that they're missing something, and I need to find a better way to explain it so that the next investor gets it. And so it's important to improve your pitch kind of as you're going, because every time you have one of those meetings, you're hopefully going to get some good feedback. If you don't, you should ask and really understand why they passed. And so we've got a question in the Q&A, and kind of just asking, why would an investor gather information without, having a strong intention to invest? And again, some of it is just, sometimes if the round isn't coming together, and there's a term sheet, and it's it's going to get done with or without them, then they're there isn't, a ton of pressure for them to decide. And so, sometimes just more information and more time, they're going to learn more. And so if you can gather more information and see how the company does over a period of time, you're going to make a better informed investment decision. And so sometimes investors just move slow, and it's not, anything nefarious going on there. Your job as a founder is to kind of create the pressure and create interest amongst as many investors as you can. And so you get the sense of investors saying, well, this is going to happen with or without me, so I need to make a decision. Do I want to be a part of this opportunity or not? And so it's really hard to manufacture that type of, FOMO, if you will. Really the best thing you could do is to create a lot of interest and excitement from a number of investors about what you're doing, so that people get the sense that they have to make a decision, and time is going to run out if they don't. And so, maybe, some other reasons, maybe an investor is just really interested in, I haven't done much in this sector. I'm learning a lot about blockchain, so I'm going to spend a lot of time talking to this blockchain company that reached out to me because I want to learn more about it. And, again, it's important to ask questions like, hey, have you ever invested in any blockchain companies? And if the answer is no, it's like, well, what do you need to understand about this space to get you interested? So it's important to understand, have they ever done an investment at the seed stage? Have they ever invested in a blockchain company? You can start to figure out, who has the ability to get to a yes without spending, months of getting up to speed on what you're doing. And I think on the nefarious side, maybe they've invested in a company that is in your space, and they're gathering intelligence about what you're doing because it informs the opinion of how they think about their other investment in that space. And in the worst case scenario, they're sharing information there. And I think people are often worried about that. I don't think it's as big of a risk, especially in a market like Colorado. It's a pretty small market. The investment community is really small, and so bad behavior like that would get around and really damage an investor's ability to do deals in the future. So I don't think it's a big risk to worry about, but it is important to look at that investor's portfolio and understand, do they have investments in companies that you would consider competitive? And if they do, you should assume that anything you tell that investor could make it intentionally or maybe just unintentionally to that company. And so you just have to kind of manage that and be careful. And, we tend to not invest in companies that are, have a conflict or competitive issue with one of our existing companies, because we don't even want to have the perception that, maybe the company that we have has gotten an idea for, a new product feature, and so does this competitor. And, when this company launches, it's like, hey, that investor told them about what we were doing. And it's like, that could not, might not be true, but we don't even want the perception. So you'll see a lot of investors say, hey, we've got a company in this space that we think has overlap or competitive, so we're just going to pass right away. And if they do have a company that's competitive, and they don't pass, then, you just have to be careful and manage that. So you will need a pitch deck. That could be a whole nother session talking about what goes in a pitch deck. There's lots of great resources online where you can see that. But again, I'll just reiterate that the pitch deck should be short, concise. You probably, for those of you who are still in school, your career center is telling you, a recruiter might only spend 30 seconds looking at your resume. A VC is going to take the same approach to an intro email or a deck that gets sent to them, where you're going to take a quick look at it. Again, they're getting flooded with opportunities, so to manage that, they're taking a quick look. Is this something that I should spend more time on? and they want to make a yes or no decision there as fast as possible so they can move on to, the thing that really should be taking their time. And so it's really important to, get into that position where, yes, this is the type of company I should spend time on. And so having that clear, concise, compelling narrative about what you're doing that really all holds together well is critical. I will say use a startup attorney. Maybe you've got an uncle that does real estate law and, they are going to give you a deal. I just don't try and save money there. There's lots of good firms that are reasonably priced that focus on kind of seed, Series A types of companies. And the documents are kind of standardized around this. So if you have an attorney that doesn't do work in this space all the time and they come up with some goofy structure, you're going to waste a lot of kind of time and legal fees getting it into a place where investors are going to be comfortable with it. But if you start with what are basically standardized documents for kind of either equity, convertible notes, or safes, then you can get you can get that done quickly and cheaply. And the last thing I'll say here is there's a lot of great resources online. Brad Feld in Boulder wrote a book called Venture Deals. It's a great book. It's a really quick read that just kind of takes you through the process, what's in a term sheet, why terms are the way they are, kind of what the market is. And so it's a great way to get up to speed. And makes it look like you know what you're doing and not, learning on the job, which just gives a better impression. Fred Wilson is one of the more popular VC bloggers. He's got an MBA Mondays series in his blog archive that kind of goes through specific topics on, how much equity should you give your early employees and all sorts of things like that can really help you get up to speed quickly. And if you want to see kind of who's getting funded and what amounts, there's a variety of newsletters out there. The Axios Pro Rata one is a good one that just shows you every day. It's a list of who got funded by who. And you can, if you follow that, subscribe to that newsletter, you'll get a sense of kind of what kind of deals are getting done, what sectors are getting funded, what amounts are these rounds getting done in, and you'll get a good sense of that. I'm gonna grab a sip of water here, and I got another Q&A. So the question is, what are the key things an investor looks for in those 30s, and what are common mistakes? Can you clarify what you mean by for those in 30s? I'm not sure if you're talking about age or if that's the return multiple that I mentioned earlier. So while I think the questioner is going to clarify that, if you can clarify your question, I'll circle back to it. But at the end here, I want to just touch on, given that we're in the middle of a kind of unprecedented, economic shock and public health crisis with COVID-19, I do want to kind of touch on, how that's impacting this landscape. And so, it is important to note that there is an overall slowdown in this kind of funding landscape. So, given that the economy is kind of on an unstable footing, unemployment is shooting up, there's questions about, how does this play out over the next year or two? The perception of risk has gone up. So investors might be pulling back a little bit. Likewise, investors who have a fund that has a bunch of existing portfolio companies in it already, those companies are navigating those challenges in real time. And so those investors might, especially if they're on the board, they might get pulled in to more kind of crisis management within certain companies that are taking direct hits. Maybe that their customer base is being directly impacted by COVID. And so they're having to kind of redo the whole operating plan and figure out how do they get through the next year? Do they have to raise more capital now from an insider group to get to the next place? And so we're seeing all that happen kind of across the landscape here, including in our own portfolio. Um, you've got companies that are taking direct hits because their customer base is directly impacted. If you sell into the sporting events industry or to the cruise lines or, places like that, your revenue could be, immediately impacted. And beyond that, all of us are working at home for the most part. So, things are just moving at a slower pace. So new sales, even if, your industry isn't getting directly impacted, things might just be slowing down. And so that just means kind of less time and capital maybe for new companies. And that kind of plays into, downward pressure on valuations. The best thing that you can do to get a higher valuation is to create a competitive environment where you have a lot of investors interested and they don't have as much leverage to negotiate a lower price. In this environment, there's just not maybe as much capital available for those same deals. So, the supply and demand balance have shifted in the investor's favor, and you don't have as much negotiating leverage as you would have even just a few months ago. And for companies that are already kind of, have raised some capital, you're seeing a lot of kind of those companies come back to their inside group of investors saying, hey, the environment sucks right now to go raise capital. Let's, do another million or so from insiders, which gives us, time to get on the other side of this before we have to raise capital. And, one of the things you might see is a pay to play round where, maybe the investors have preferred stock and, there's an inside round getting done, and, to make sure that everybody kind of carries their own weight and there's no free riders, they might say, anybody who doesn't participate is going to get converted to common and lose some preferences and privileges. So, you're seeing things like that happen. Certainly based on who you sell to, that is a very important. So if you're selling to kind of restaurants and consumer facing things in general, investors might not want to fund your company right now because they don't know kind of what your next year looks like. Whereas if you're selling to, or you're producing remote work tools and things like that, maybe the environment's pretty good for you. So you really have to think about, who do you sell to right now? How are they being impacted? And do we have the ability to make any progress this next year? Do we have to wait? That's really going to change your approach.
So, Aaron, I just want to let you know we have 2 minutes left. So, if you want to wrap up anything or give out information, if people want to contact you more about like questions that they have, you can do that. But after about 11:30 to 11:33, I'm going to stop the stream.
Yeah, we've got one more question through the website here, through the chat. I've pulled up my information. You can follow me on Twitter. You can follow our fund on Twitter to learn kind of what we're doing, what our companies are doing. My website is up here, firstmilevc.com. There is a contact form. It comes straight to me if you want to reach out. Feel free to send in more questions on the chat in our last couple minutes here. There's one here about how to make a positive first impression in the first 30 seconds. I think it's 30 seconds might be kind of a short time frame, but I think usually within the first 10 or 15 minutes, I start to get a gut feeling of whether or not this is the type of opportunity I want to spend more time on. And again, it usually has, within a short amount of time, say 5, 10, 15 minutes, the management team or CEO can convince me that this is a big opportunity based on, the unique solution they're bringing to a big market. Their background kind of positions them perfectly for this because, they learned something that most people haven't figured out yet, and they understand the competitive landscape. They know the customers. They kind of pull together that narrative that quickly says, this is a big opportunity. It's, based on these things happening in the world, it's kind of obvious, and, we're really well-positioned team to go do it. And so, you don't want to beat around the bush with all those things. You should really be able to condense your kind of elevator pitch into something that really clearly shows people, what you're doing and why it's important. And, there's another question on, how does age affect an investor's impression? And I think, it can be really important in certain industries, the amount of experience you have. So like we invest a lot in B2B software, and to really, I think, understand the landscape of enterprise customers and how they buy and what their needs and pain points are, you have to have spent time in those environments to really understand those problems and how software gets purchased at that level. Where if you're doing something, for social media geared towards, Gen Z consumers, the 40-year-old software executive probably has no idea how 17-year-olds are using their phones and what they want to do on them. And so in that case, a younger founder might have their finger on the pulse of something a lot more than an older, more experienced founder would.